All right, let's dive right in. We're going to peel back the layers of the stock market and try to build a framework around one of the biggest, most fundamental questions in all of finance.
And here it is. Can you actually, consistently, beat the stock market? I mean, it's the multi-trillion-dollar question, right? Every single investor, whether you're just starting out or you've been doing this for decades, has asked this. And believe me, classic economic theory has a very strong opinion.
And that opinion is called the efficient market hypothesis, or EMH for short. It's this really powerful idea that says a stock's price already reflects all the available information. We're talking everything from earnings reports to the latest news headlines, it's all baked right in. So if that's true, well, trying to find some hidden gem, some undervalued stock, it's a total waste of time. The game is basically unwinnable from the start.
Okay, so let's explore this. What would a perfectly efficient market, this supposedly unbeatable game, actually look like?
This idea comes from Nobel laureate Eugene Fama, and honestly, it's pretty much the bedrock of modern finance. The core concept is simple, really. The market is this perfect, flawless machine for processing information.
Let's try an analogy to make this a little more real. Think about a car engine, a combustion engine. You put in 100 units of fuel, right? But you only get about 25 units of actual work, of forward motion. The rest, it's just lost as heat. That's inefficiency. Now, apply that to the market. The fuel is information, and the work is an accurate stock price. A perfectly efficient market would have zero waste, zero heat loss. Every single scrap of information would instantly and perfectly be reflected in the price.
But, and this is a big but, here's where this beautiful, clean theory hits a massive wall. There's a central paradox here, and you just can't ignore it.
Yeah, just think about it for a second. If the market is totally perfect, if every bit of info is already in the price, then why would anyone bother doing research? Why would a hedge fund spend millions of dollars on analysts to dig through financial statements or interview company management? What's the point? Well, this is what's known as the Grossman-Stiglitz Paradox. It's this brilliant insight that, hey, for prices to get efficient in the first place, somebody has to do the work. Someone has to gather the information. And to get people to do that expensive, time-consuming work, there has to be a reward, right? A potential profit. But a perfectly efficient market offers zero reward. So no one would do the work, and the market would stop being efficient. It's a total catch-22. So this leads us to a much more realistic and, frankly, a much more useful idea. The market isn't perfect. It's efficiently inefficient. What does that mean? It means prices are mostly right, but not completely. There are these little gaps, these small arrows in pricing, and that's just enough to create an opportunity for skilled investors to get paid for their effort. That potential profit, that's the fuel that keeps the whole information engine of the market running. Okay, so what does this efficiently inefficient game actually look like on the inside? Well, the reality is probably not what you think. It is a game of extreme, and I mean extreme winners and losers. Let's just start with this number. It's pretty staggering. Researchers looked at almost 100 years of U.S. stock market data, and what they found was that 59% of all individual stocks actually destroyed wealth for investors over their lifetime. Just let that sink in. The majority of stocks did worse than just sticking your money in super safe Treasury bills. And it gets even starker. A totally different study found that since 1975, 71% of public companies never made enough money in their entire existence to justify the price investors paid for their stock on day one. So you're probably asking, well, where does all the money come from then? It's incredibly concentrated. Get this, just 2%, of all stocks were responsible for more than 90% of all the net wealth created in the entire market. The whole game is driven by a tiny, tiny fraction of massive winners. And this table here really breaks it down for us. Look, the story is the same no matter how you slice it. Whether a company survived, got bought out, or just disappeared, a huge majority, we're talking nearly 71% overall, never justified their initial stock price. It just goes to show you how incredibly skewed this whole game is. So this reality, this skewed market where finding a big winner is like finding a needle in a global haystack, it's caused a massive shift. A seismic shift, really, in who's playing the game, and maybe even more importantly, how they're playing it. You can basically break down the players today into two big camps. On one side, you've got your active managers. These are the detectives, right? Their whole job is to do the research, pound the pavement, and find those little inefficiencies to try and beat the market.
They're the ones doing what we call price discovery, the hard work that actually sets the prices. And then on the other side, you've got the passive index funds. Their goal isn't to beat the market, it's just to be the market. They just buy a little bit of everything in an index, and in a way, they're kind of free riding on all the hard work the active folks are doing.
And the money flow between these two camps? It's been absolutely monumental. We're talking about a $6.4 trillion swing away from active funds and into passive ones since 2006. This isn't just a small trend. It is fundamentally rewiring the entire market ecosystem. So this brings us to the most important question, right? In this new world, with a tidal wave of money flooding into passive funds, and all our returns coming from just a handful of stocks, where do the opportunities even live anymore? Where are the inefficiencies? If you're going to play this game, you absolutely need a map. So where can you actually find an edge? Okay, so where can we look for that edge? Well, the research points to 4 main areas. Think of this as your treasure map. First up, there's behavioral. This is all about human psychology, exploiting the market's mood swings, the irrational fear and greed that we all know so well. Second, you've got analytical. This is simply about doing better homework than everyone else, or maybe just having a longer time horizon than a market obsessed with the next 3 months. Third is informational. This is about getting your hands on unique, crucial data that other people have missed, giving you a peek into the future before they see it. And last, we have technical. This one's a little different. It's when prices get pushed around for reasons that have nothing to do with the company's actual value, like a giant fund being forced to sell a huge position because of its own internal rules. And so all of this brings us back to one final critical question you have to ask yourself every single time you buy a stock or sell one. Remember, there is always someone on the other side of that trade. So now that you understand this framework, the skewed returns, the changing players, the different sources of an edge, you have to ask, who is on the other side of my trade? And what exactly do I think I know that they don't? Answering that question, honestly, well, that's the whole game.